Last but not least, we have the cash flow margin ratio. This is one of the more important profitability ratios for business owners. It indicates how well the company converts sales to cash, which we all know is important since it's required to pay expenses. The higher the percentage, the more cash is available from sales. The cash flow margin formula takes operating activity cash flow and divides that by net sales. You know the drill by now. Let's calculate this bad boy using an example. Let's look at Splendid Soirees Event Company. I just love that word, soirees, don't you? It had an operating cash flow for the year of $34,000 and net sales of $54,000. Don't forget, net sales are found on the income statement. So, plug those numbers into the formula and you get 0.631. This means that the operating cash flow margin for Splendid Soirees is 63%, which in turn means that for every dollar of net sales, 63 cents is operating cash. An operating cash flow margin above 50% means that the company is efficiently creating operating cash from its sales. So, a 0.631 ratio is good. The higher the percentage, the more cash is available from sales. A negative operating cash flow margin is an indication that the company is not making any profit but rather losing money. One way a company can improve operating cash flow margin is to collect all accounts receivable in a short period of time. Though this might be tricky as there's a risk of losing customers. A company can also put in incentives for customers to pay on time. Let's hear from my good friend now who will fill us in with more details about this ratio.
The cash flow margin ratio is a profitability ratio. So we are going to be looking at the ability of a company to turn its operating activities into cash. So this is going to be really helpful for a company, especially if they do have sales that are going to be on accounts receivable. So it can be used in conjunction with other ratios we talked about before. It's also helpful for profitability analysis by investors and other financial analysts. But again, it's all about taking their cash out of the revenue that they have received in that period. So really it's cash flow from the operations divided by the net sales. And that's how you get your cash flow margin ratio.